Mihir Vora, Director and Chief Investment Officer at Max Life Insurance, is now joining us. Mihir, thank you so much for taking out time for us. Do you get a sense that markets got very, very pessimistic going into the Q3 numbers, and Q3 numbers may not be as bad just because of demonetization?
Hi, good morning. Well, the market probably was oversold, and we did see some global traction in the materials space, which kind of triggered a bit of a short covering in a lot of the portions of the market. However, it's too early to call the results season because we've seen numbers come in from some of the larger good quality companies, and we still have a long way to go. So we'd rather see the results across a broader portion of the market rather than rely on the first few results, which typically tend to be the better companies in any case.
Right. Would you believe that markets are yet not in a overbought region or where valuations are slightly alarming? If somebody was to invest now on a 1 to 2 year basis, still positive returns can be generated?
Oh, absolutely. Valuations, I don't think is a concern at all. Even at 5-7% higher from current levels, I don't think valuations would be a source of concern. What matters is the certainty and the trend of growth, especially growth in earnings that we are talking about. So markets are trading at a PE of probably 16.5 on a 1 year forward basis, which is quite reasonable, I would say. What one needs confidence is in the EPS growth numbers for the broad segment of the market, which is something which we are looking and observing very keenly over the next few weeks as the results start pouring in. The thing to note is that not only is the Q3 number important, but even the Q4 numbers are important because we have seen that in certain cases there have been inventory drawdowns, inventory destocking in the month of November and December, and that probably might have been some kind of a preponement of sales, etc. in some segments, and whether that translates into a slightly sluggish Q4 is something that we need to see. And we already seen some numbers in January, and February will also be an interesting number. So lots of moving parts in the market, I would say.
Going into the budget, do you think markets is already expecting that a lot of reforms may be announced in the budget, a lot of SOPs may be given in, which the markets have already priced in?
We did see some indication of the thinking of the government in the Prime Minister's speech on 31st December. So going by that trend, it does seem like we'll see some relief for the masses, especially on housing, rural segments, and those kind of things where the Aam Aadmi or the Aam Janta will benefit. So I suppose a lot of it is already being talked about, especially after the speech. You did see some excitement happening. Given the fact that monsoons were okay and agri production should have been okay in the winter crop also, we would say that consumption is a theme that one should be looking at. And of course, financials, as we know that without financials growing, we can't see GDP growth. So these are two pockets one needs to closely monitor going into the budget and even after that.
As far as the global flow picture is concerned, do you expect FII selling to continue?
Well, the dollar continues to remain strong, and we do see the Chinese currency continue to devalue. So that trend, unfortunately, doesn't seem to be reversing in a hurry. We have got a couple of big events coming up. One is the inauguration of the new president of the United States, the budget, of course, probably in the first week of February. And then we also have some statements being made by the UK Prime Minister on hard Brexit. So the things are not right for a risk-on trade in the global scheme of things, I would say.
But do you think that the dollar index particularly that you mentioned, when it went from 70 to 100, there was a global rally. So even if it grows from 100 to 110, do you think that a lot of outflows would happen, or it will just be a knee-jerk reaction?
So that's a function of what the relative growth expectations are going to be between developed, especially the US markets and the emerging markets. The way the new president of the United States is going about things, it looks like he wants to kickstart local growth in the US, probably at the expense of the rest of the world. And if that is successfully implemented, then we could see some pressure continue as far as the exporting countries are concerned, and most of them are emerging markets.
overall, so far the trade has been developed by developed markets and sell emerging markets or redeem from emerging markets. There is no reason for that to change at this moment.
Yes, I would say that continues as long as we see some more clarity on the US policies. That will continue. However, I would say that India will continue to stand out as a little bit of an exception amongst the broad scheme of things in the global market, because if you look at China, Brazil, Russia, Japan, Korea, all of these are heavily dependent on exports, not only to the US but to the rest of the world. And in case there is a disruptive policy environment on global trade, then these are the countries which will be impacted much more. India, as things would have it, is running a trade deficit, unlike most of those countries. And to that extent, we are insulated. We have a very strong local story. And if we manage to get a few things right on manufacturing and start manufacturing more and more locally, as the government has been trying to do for the last 2 to 3 years, then we could see a structural story which has been building over the last couple of years. A lot of it has been hope. But if we actually manage to execute it, then we can continue to shine in a volatile environment.
But as of now, if somebody wants to buy or go overweight on certain sectors, domestic linked sectors would be better. The companies that are more dependent on domestic orders, domestic consumption.
I would say yes, because a lot of the correction that has happened in the last couple of months is in these segments, because they had run up quite a lot to start with. So my bet is that if India has to grow, if India has to grow in the next 12 to 36 months, it has to have two pillars. One is government support in terms of infrastructure spending and enabling infrastructure creation. Government support on housing. So one broad theme is government support on housing and infra, and second is robust local consumption that should continue. The only pocket probably which is a little global and might do well in case the US does manage to kickstart growth is metals and some of the other global commodities. But apart from that, I would say that domestic theme will be a better theme to play in the next 12 months.
Right. And in terms of domestic recovery or consumption recovery, how much are you worried about demonetization and the impact on any of these consumer sector?
So as I said, that's something that we are very keenly watching. We are expecting some of the companies in the Q3 results to disappoint. Probably markets have already factored that in. We'll see how it goes. But also equally important, as I mentioned in the earlier part, is the carry on or spillover onto Q4. Whether Q3 was the end of it or there is a spillover of this demonetization impact on Q4 is something that is very important, I would say.
And even in Q4, you think, or rather after Q3, always management commentary is always important. But do you think that only after Q4, markets would believe if there is a structural slowdown or no?
I would say that, yes. I'd say markets will kind of consolidate at these levels because you have to analyze the data of Q4. So let's see how February numbers pan out. Let's see how March numbers pan out. So I would say we need more information on whether the demonetization impact is going to last only for a quarter or probably 2 or 3 quarters. So we need some more data. And of course, I don't think market participants would take huge calls just a few weeks before the budget, because of course you can have a whipsaw on either side. So I would say markets were oversold. They have bounced back from the lows, and it's time for a bit of a consolidation phase, I would say.
Right. Just a word on the budget in terms of, say, if there are some SOPs or some stimulus which is given into the budget, and it's slightly expansionary in the nature, do you think investors would worry as to what's happening to the fiscal targets?
Well, I don't think equity investors would worry because we do need larger government participation. Unfortunately, private sector capital expenditure just hasn't kickstarted in the last so many years now. We've seen investment slump from the private sector for many years. We don't want to go into the reasons. It's a whole host of reasons, but the fact remains that private business is just not investing. So then the only other two legs which we can stand on as an economy is government spending and local consumption, which is what one has to bet on. The bond markets, however, may react a little bit negatively, given the negative commentary that is likely in case we manage to not follow the promised path on fiscal deficit.
But overall, low interest rates in the system plus a stimulus will lead to growth in second half?
Well, that's the hope. I don't think lower interest rate itself can be a sufficient condition to stimulate growth. Otherwise, we should have had growth already beginning, because we've been cutting for almost 18 months now. It has to be backed by government policy and a feel-good environment. And that is something that is a combination of a lot of things. Well, unfortunately, we also have a little bit of disruption coming for the private sector, which is the implementation of the GST. While structurally it will go a long way in improving the tax to GDP ratio, transferring the unorganized economy into the organized sector, but it might lead to a few months of disruption as people reorganize their IT systems, their reporting systems, their internal MISs, their logistics, their warehouses, etc. So I would say that next 1 or 2 quarters is something that we'll have to see, both from the impact of demonetization as well as on execution of the GST.
Will banks be one of the best to play this recovery?
Yes, definitely, especially the private sector financials in general, not only banks, but even the NBFCs, etc., small payment banks, NBFCs, etc., because, the public sector, as we keep on saying, just doesn't have the capital to grow. They are still not out of the NPA issues that have been plaguing them for a while. And if the economy does have to grow at 7.5 or thereabout, the credit growth in the system has to be 15 to 20%, and that cannot come unless private sector financials kick in. So if we do believe that India is on a 7+ kind of a growth trajectory, then private sector financials will have to do well.
Right, and the initial numbers from IndusInd Bank, DCB Bank, which have come out, show that the impact may not be as high in the private banks as it was earlier feared.
So that was always the assumption that private sector financials will be much less impacted. However, we need to see what happens after the 90-day norm is passed. So that's the reason I keep saying Q4 is also important. We just can't go only by the Q3 numbers.
Do you think NBFCs are a buy after the correction?
We believe that NBFCs are a structural buy in any case, with or without the correction, because they have to grow much higher than the system, as I mentioned. And even as we speak, the cost of funds is coming down. They are wholesale borrowers, most of them, so they will benefit from cut in interest rates that we foresee over the next 12 months. And more importantly, India is still a very underpenetrated market as far as private or you can say consumer credit is concerned across segments, whether all the way down to microfinance and all the way up to auto finance. We still have a long way to go in terms of penetration. So I would say it's a structural story, irrespective of the impact of demonetization or the correction that we have seen.
NBFC itself is very big. Can you just tell us what do you like within that? So you like a retail name which focuses on consumption, you like a MFI, or you like a housing finance companies?
We'll actually like all the segments, frankly. As I mentioned, all the way from the small ticket MFI financier, all the way to the auto and the truck financiers, car and the truck financiers. Because as I said, the penetration is still low. All the target segments also are under penetrated. So whether we talk about car penetration or microfinance penetration, across the spectrum the penetration is low. So we do have a long way to go. The only thing that matters in these cases is your trust in the management. They have to be done efficiently. The credit appraisal systems and the risk management systems are all that matter, frankly. The growth is there for people, for good managed companies to take, as long as they don't blow up over a cycle. That's where the risk management, the credit and the quality of the management comes into play.
Right, and in terms of NBFCs and the history, there are a lot of companies in the listed space which have time and again proven that they have the ability or the efficiency that you were talking about. Any major fall means that one should buy these names?
Absolutely, that's what we say, yes.
Right, and in terms of concerns regarding Q3 numbers, there could be a little bit of extra provisioning, extra problems in the gross NPA numbers. You think market would punish these companies in the interim?
I have a feeling that the Q3 numbers may not be as bad as one expects because of the 90-day extension that has been given for provisioning on small size loans. That's why I keep saying that Q4 numbers are also important, because that's when we will see the extension of the 90-day norm going away. So I think we need to see Q3 and Q4 cumulative numbers rather than only Q3 or only Q4 numbers.
Right. Mihir, you said that mere low interest rates is not enough for growth. We need policy reform. What is it from the budget in terms of policy reform would you be looking out for?
So as I mentioned, some inkling was available from the Prime Minister's speech on 31st December, where he did talk a lot about housing and the rural economy. So we should see a broad theme of supporting affordable housing, supporting the rural farmer, supporting incomes, probably more aggressive rollout of the direct benefit schemes, etc. So that is one theme that one should look out. But I would be happier if there is a massive thrust on government initiatives on infrastructure directly, because we've been trying the public-private sector participation route for a long time. And unfortunately, the private sector is in the doldrums and they are just not investing in a big way. So we just need these large ticket infra projects also to be taken up at the state and the central levels on a more aggressive footing to kickstart the economy. Because this will not only create immediate growth, which we desperately need on infra, but it will also create the capacity for future growth. Because if you look at any segment of the infra space in India, it's choking and we are always under capacity. We always have a lack of capacity, so to say. So I think it's time that we became much more aggressive on infra creation, and the government will have to kickstart it, because the private sector is just not forthcoming at this point in time.
Right.
So that's something that I would really want the government to focus on. Yeah.
And are you expecting this big infrastructure trust because of the windfall coming in from demonetization? You said the bond markets will not warm up too easily on a slip in the fiscal roadmap. How will these two tally? I mean, where is the spending for extra, and where is the money for the extra spending coming from?
So we don't have data on demonetization. There have been conflicting reports. So that's something that we should not factor in. Probably what we could factor in is higher tax collections because of improved disclosures going forward. Not only because of some portion of the cash economy coming into the formal system because of this move that we've seen, but also because of the rollout of the GST. So maybe a higher tax to GDP ratio is something that the government may assume in the budget, and that may be used to finance the additional spending.
But the GST, it's all but now given that it will not come in on April 1. While it is a long-term benefit, don't you see short-term disruption? And what will be the impact on growth in the interim? Do you think it could still be sluggish till about the second half of FY18, FY17?
Yes, that's what we just discussed. As I said, in this quarter we have the budget and the US presidency inauguration, and in the next quarter probably we should see some kind of a pause by the private sector as far as making big decisions on spending, etc. are concerned, because they'll be figuring out their IT systems, their back-end systems, the reporting MISs, probably even rationalizing of logistics and warehouses before the rollout of the GST. So we could see one quarter, which is the 1Q FY18, not being aggressive in terms of growth as far as major investment decisions are concerned. Normal business as usual growth, I think, will happen, but big decisions may not be executed in that quarter because managements will be busy with the GST implications.
Right. So if you're expecting a big thrust on public infrastructure, how would you play it? What are the stocks that you would look to buy? And what are the ones that you'd look to avoid, even when it comes to public infrastructure? You said private capex is not picking up. So would you then avoid the long-term the long cycle capital goods names? How would you play the infrastructure theme?
So we typically would and also are biased towards the construction and engineering and EPC companies, companies which have survived the downturn and have balance sheet strength to kind of take on new orders. So a lot of them are not the erstwhile big companies, probably more of the mid-cap space. That is something that we can look at, and we have been looking at. And the other segment is basically the asset owners, but we are not that gung-ho on asset owners. So we'd rather play the EPC and the construction companies, not the asset owners.
Where does real estate fit in here? Because we've already seen a thrust from the government on affordable housing, and real estate is a big employment generator as well. It uses material. Unless we see a revival there, do you think this the growth will be durable? How would you view the real estate space?
So when we think about real estate, we typically tend to think about the big urban projects. However, 60% of the real estate market or the real estate created in India is in the tier 3, tier 4 and the rural economy. That's where 60% of the cement gets consumed basically. So I think even if we are able to roll out affordable housing on a mass scale across the smaller towns and the tier 3, tier 4, tier 5 even places, I think that should be good enough. Urban, I think as far as urban real estate is concerned, it's really pockets. So probably places like Bombay and NCR would remain sluggish. However, in certain pockets like Pune and Hyderabad, etc., Pune and Bangalore, etc., there is a lot of IT and ITES activity happening, and those segments continue to see normal growth. So it's really from case to case. But if we are talking about kickstarting the economy, I think it's not these ITES kind of developments which will kickstart it. It will be the mass affordable housing and rural housing kind of initiatives which are needed.
So are there any stocks in the listed real estate area that you like? Because we don't know of very large affordable housing players that are listed.
Yes, I agree. So that's why you probably again want to play it through the EPC guys and the people who will deliver those houses rather than developers.
And what about cement and steel? Would they also tend to benefit from this entire process where housing will be given a thrust? How would you view these two sectors?
Well, cement, yes, it can benefit. But again, cement has to be looked at regionally. There are imbalances in supply and demand. So probably the north and the west probably are a little more, in oversupply, and we do see some benefits coming from the east. So it's going to be a mix and match kind of a thing. It's a cement, I would say, is a cyclical commodity, and supply demand tends to kind of keep coming up and down. So it's a sector we are bullish on when things are really looking bad, and we are not so bullish on when things are really looking good. So it's a domestic cyclical, I would say. And the way to play it is, buy when things are looking bad and sell when things are looking very good. Steel tends to be a global commodity. So probably Indian demand alone cannot drive steel markets. India is a smaller player in the overall scheme of global things.
Okay, and in the consumption names, what would you veer towards? Because there is still a belief that, the high value consumption items, durables, there may be a wealth effect and hence they may suffer for a longer time. How would you play the consumption theme?
So in consumption, we have been more bullish on the discretionary space for a couple of reasons. One is, of course, penetration is lower in the discretionary space, whether we talk about cars or two-wheelers or things like that. And the other is lower interest rates. So especially in the car segment, lower interest rates will benefit car sales as we go. But in the last few months, since even FMCG and those kind of stocks have corrected, paint stocks have corrected to some extent, it may be a good time to start looking at those. Valuations have become quite frothy, though they are still expensive compared to rest of the market. But I would say that since stocks have corrected 15, 20, 25% in a lot of these cases, probably it might be a good time to start looking at even the FMCG stocks.
Other than consumption and infrastructure, are there any sectors or stocks that could be, benefit from the budget? Could there be an outlier there where investors can expect strong returns?
Yes, you did mention one pocket, housing finance companies. as the government probably tries to improve the subvention schemes, etc., you may see a growth in the loan book, especially in the smaller ticket segment. So that is one segment probably one should look at some point in time.
Mihir, in terms of some contra sectors, do you like real estate pack? Do you think the worst is into pricing? Everybody is expecting that real estate may not do well.
In real estate, I would look at the markets, each market separately. Let's put it that way. So, for example, if a developer has a massive exposure to, say, Gurgaon or Noida in the residential space, one may not want to look at it. But in the residential space, maybe Bangalore is a better place to be, because there the supply demand and the pricing is much more even and much more steadier, I would say. One should also look at potential candidates where they're going to monetize their commercial assets into maybe REIT structures, those kind of structures, and then one looks that's a way of kind of unlocking value in some of the companies. So those are plays which are available at this point in time. But broadly speaking, I would say commercial space in places like Bangalore is something one should look at, not so much in the residential space.
Also, as far as real estate is concerned, when I asked you about budget, you said that focus will be on housing, focus can be on slightly more stops towards housing. So would you look at affordable housing, companies which are into the affordable housing space?
Yes, I would like to. Unfortunately, there aren't too many large liquid companies in this space, and as I just mentioned, because of that, you still might want to then focus on the EPC guys who are going to deliver those thousands of homes. So it's an indirect play, but I don't see many direct plays on this, frankly.
Right. When we spoke about NBFCs, you said that you like all the NBFC companies. Some of the earlier guests that I've spoken about on the real estate pack says that housing finance companies are a better way to play that. Would you agree, or do you think that real estate has to be looked separately?
So housing finance companies in general is a very safe business, is a good business. So I would, as I said, in the NBFC segment, most of the segments are underserviced by the public sector, and there is ample scope for all the companies in all those segments to grab market share. So I think housing finance is something, and within housing finance you have the higher ticket ones, the large companies, and the smaller ticket ones, the smaller companies, and both are growing, I would say. So housing in general as a theme for a young country like India should continue to do well. We have seen loan growth coming off, especially in the larger companies over the last few quarters. And I do think that's a function of probably a little bit of urban slowdown. But as the economy picks up, even the credit growth in the larger companies should pick up.
Mihir, thank you so much for taking out time for us.